1.05750 is a well-respected supply zone, you could place a sell limit at this level. Then for your stop loss, you'll use a key level to set your stop loss. For instance, over here, you'll place your stop loss just above the key level to minimize your risk. And then for your take profit, you'll use a key level with the confluence of a demand zone for your exit. And this gives you a solid risk-reward ratio. Welcome traders. So today I'm going to be showing you why you may not be getting the results you expect when you trade using a strategy that uses support and resistance. And in this video, I'm going to be showing you how to use key levels and supply and demand zones instead. Let's get started. So as you know, Forex trading is very risky and most traders lose money. And you should note that this video is for educational purposes only and it's simply to provide trading ideas. Now, before we jump in, I just want to quickly run through support and resistance. I've made a lot of videos on the subject and we've got a lot of podcasts that talk about support and resistance, and I will place some links to those in the notes below. But before we get started, I just want to quickly dive into what it is, and I want to show you how market psychology and historical price action can affect support and resistance. So support is created when buyers step in to prevent the price from falling further, and it's a level where demand is strong enough to overcome supply. Resistance is created when sellers step in to prevent the price from rising further. So it's a level where supply overcomes demand. It's important to note that these levels can flip roles. So for example, if a resistance level is broken, it often becomes a support level and vice versa. This is known as role reversal, and it's a very powerful concept in trading. Another thing to note is that support and resistance can be dynamic. So they can also be denoted by things like channels or trend lines, moving averages, Fibonacci levels. So they're not just horizontal lines or horizontal zones. Now, instead of just focusing on support and resistance when trading, I like to focus on key levels and supply and demand levels as well. This is where the institutions are most active, and so these are levels you should be aware of too. So what are supply and demand zones? Supply and demand zones are basically zones where very aggressive buying or selling activity has occurred, and they cause noticeable price reversals or strong movements. So as you can see here, this is a supply zone where selling pressure exceeds buying pressure and it causes the price to drop. And it often acts as potential resistance when it's revisited. If we look at this demand zone, this is where buying pressure outweighs selling pressure and it causes prices to rise. And it tends to act as support in the future. Next, I want to look at how you identify key levels. Now, key levels are price zones where the institutions are usually very active. They are typically at round or consistent intervals like the 0 level, the 250 level, the 500 level, and the 750 level. For example, on the Euro USD chart over here, the 1.0600 level, 1.05750, 1.0550, 1.05. Now, you want to avoid cluttering your chart because it can obviously become very confusing as to what you're looking at. You want to focus on the key levels that match up with the key supply and demand zones to be more effective. So how do you trade using key levels and supply and demand zones? Firstly, if you look here at my chart, you're going to look for key levels with supply and demand zones for precise entries. For example, as you can see here, if 1.05750 is a well-respected supply zone, you could place a sell limit at this level. Then for your stop loss, you'll use a key level to set your stop loss. For instance, over here, you'll place your stop loss just above the key level to minimize your risk. And then for your take profit, you'll use a key level with the confluence of a demand zone for your exit. And this gives you a solid risk-reward ratio. This method minimizes your risk and it maximizes your profit potential by aligning your trades with areas where the big players operate. Now, I like to trade on the 4-hour time frame. I find that it cuts out the market noise of the lower time frames, but it also gives your trades enough time to get to those different key levels. But this is just a personal preference, and this method does work on the lower or higher time frames. Now, I just want to address some common pitfalls that many traders experience. Number one, Avoid overloading your chart. Too many lines often lead to confusion, and it's very difficult to see what you're looking for. Number 2, you don't want to ignore your confluence. Don't rely solely on key levels. Pair them with trends, candlestick patterns, or with your supply and demand zones. And with that, another pitfall is poor risk management. Always set stop losses and trade with the risk-reward ratio in mind, and of course, never risk more than you can afford to lose. So you should have a bit more of an understanding of how to use key levels and supply and demand zones to find your entries and set your stop loss and even your take profit. If you have any questions, please don't hesitate to contact us. Our website is fxscouts.com, or write us in the comment section below. And please remember to subscribe and like, and I'll see you in the next video.